The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm your host, Brian Akers, and today on Winning in Retirement, we have a very special topic. That topic is this. That is long-term care, and the important word is care. The real threats to your legacy and retirement. Akers Financial Group sponsors this show, and we want you to be winning in retirement. And we think each and every person, as they entering or throughout their retirement years, need to answer these questions about long-term care and what is their family going to do about it. So what we've done is we invited a special guest. We invited Jeff Stemler, Vice President of Advanced Planning from AMS, to be with us today. Good morning, Jeff.
Good morning, Brian.
It's great having you on the radio show today. We also thank you for all the years that I've been able to work with you and all your help with my clients as we try to build case by case and client by client the right answers for their family decisions. Now, Jeff, you have all these letters after your name: CLU, CHFC, CFB, CLTC, all kinds of things. Those are all classes and training you've done throughout your career.
Yeah, that's correct.
So you don't have a doctorate in advanced planning, but you have every designation you can think of, right?
I think there's probably a few more floating around, but yeah.
There is. I ran out of breath as I was describing them all. So Jeff Stemler is on the radio show today for one purpose, and that is to talk about long-term care and to understand the issues that we need to face that we haven't been facing. What has been your experience, Jeff?
Well, the overwhelming experience is the fact that most people spend their entire life, looking forward, trying to put together a retirement plan. And they spend absolutely zero time looking for that blind spot. And the long-term care, without a doubt, is one of the largest blind spots in their financial plan. One of the, they worry about the taxes, they worry about the inflation, they worry about the market risk for their portfolio, but long-term care in one fell swoop can just wipe everything out. So that's been my experience, is that most people really have not been thinking about it, and even if they did, they're not sure what to do.
Yeah, I think what you're basically saying is that long-term care and long-term care insurance and life insurance could be the left tackle for the front line that we need when we're quarterbacking our retirement. So in Baltimore, we understand the blind side and covering that blind spot. That blind spot every quarterback has, where the highest paid defender comes right at you. So we understand where you're coming from with this blind spot concept. So the blind spot is that we're so excited about market investing because those are all positive things. We don't really take time and think about a worst case scenario, rather whether it be ourselves getting sick or us taking care of our parents or someone else in the family. That's a very, very important time of life, especially as you're entering retirement, to understand there's people to take care of that are older and younger. So it is a very important topic.
Yeah, and what's amazing is people really are not aware of the magnitude of the whole issue, because when I'm talking to clients, I say, I'm going to give you four numbers, and they're very important, and that is 70, 93, 30, and 100. And that is 70% of us are going to need long-term care at some point for some duration. Yet 93% of us don't have any long-term care. And by the way, it's understandable, because for a lot of people that looked at long-term care in the past, it just wasn't affordable. And the problem is the traditional long-term care continues to, if you do have it, the premiums continue to grow. And much faster than inflation. We had one carrier that raised their rates 80% in 1 year. So that can scare a lot of people. The good news is the products have evolved, and now they are guaranteed. The premiums are guaranteed, and they're not going to go up. 30. That number 30 represents the 30% who won't use it or need it. And unfortunately, most people rationalize themselves saying, well, I'm one of that 30, and so it's going to happen to the other guy. When in fact, that's not, 7 out of 10 times it's not going to be true. And then finally, that 100 stands for if you don't have long-term care insurance, you're self-insuring 100%.
Right. So this long-term care, let's break down how this happens in someone's life. Do you have a client situation where you can try to explain how this comes to happen in a family or in a person's life?
Well, I think when I'm talking with people about this, the first question I have for them is, have you ever been a caregiver, or do you know somebody who has? In my case, I just tell them my own story. My mother-in-law had Parkinson's, and there was my wife, my sister-in-law, and myself. And for 2.5 years, it was like Groundhog Day. Every third day, we were with my mother-in-law, and it just, you can't abandon them. You must take care of them. You love them. And so what I'm trying to get across when I'm talking to a client is that you really need to understand what are the consequences of not having long-term care insurance.
Absolutely. Now, those numbers you were saying, you said 70% will need some type of long-term care. So that means when someone gets sick and goes to a hospital and as you're getting a little bit better, you improve to a certain point. But when you stop improving, that's when Medicare stops paying. And actually, when Medicare stops paying, you have to start paying for your own extended care. And that's truly when long-term care begins.
You're absolutely right. And as a matter of fact, most people are not aware that 30% of all long-term care claims are for people younger than age 65.
Wow.
So either a stroke or a severe accident or something of that nature has triggered the event.
Right. And then you use this number 93. You're saying that 93% of people in their retirement years have no plan for long-term care.
Well, no plan. That's probably closer to 99%.
Okay.
But 93% don't have any long-term care insurance. And I understand why people are reluctant, because their past experience has been long-term care, when it first came out in the late 70s, was priced and underwritten very much like auto insurance. You basically paid a premium. If you didn't use it, the money was gone. But like auto insurance, you may never have had an accident, never had your car stolen, yet your rates go up, right? Well, that's because your neighbors have had the accident and your neighbors have had the cars stolen. And so the long-term care coverage or policies, the premiums just keep rising and rising. The new version, the newest iteration, these policies have guaranteed premiums. They're locked down. They can't go up. And it's a whole different ballgame.
Yeah. When you talk about caregivers and you talk about not addressing this with some type of funding vehicle like insurance, the caregiver is one of the hardest jobs someone will ever have in their life. And what happens, it seems, is that the caregiver, their life is also changed by this kind of event. Maybe a parent or another person in their family gets sick, and that changes the life of that person, but also the caregiver.
Without a doubt, and again, when I'm sitting there talking to them about the long-term care, I really try to emphasize to them that for the caregiver, I mean, the person who's going to need the care, you're going to get it one way or the other, whether it's from your relatives or whether it's because of Medicare or Medicaid. You're going to get it. But the caregiver, long-term care, providing that care is a life-changing event with catastrophic consequences, both emotionally and physically, for those caregivers. And like I say, it's very, very much like Groundhog Day, because, they need care 24/7. And so, you have to make arrangements. If you need to go to the grocery store, you've got to have somebody stepping in for you while you're gone. So again, it's extremely difficult.
Absolutely. I've heard you speak many times, and one of the things you talk about is the Groundhog Day idea, where you wake up in the morning, you have to take care of that person to get them ready and up and out of bed, and then lunchtime, dinner time, bedtime. There's all these events of just maintenance and care, and that's really the key to long-term care, is really being there for someone. The goal of our radio show is this: we want you to be winning in retirement. Winning in retirement is prepared for all that life brings us. We'd love to talk about growth, income, and legacy, but what is some of the biggest threats to our legacy and our retirement? And that is this subject, long-term care, and the important word is care. How is that care going to happen? We want the best part of retirement to be about getting your time back and be able to make decisions and choices and travel and all these exciting things that you look forward to. But you need to be prepared for the worst case scenario also. And that's why it's so important that you go ahead and give Akers Financial a call. Give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message, and Susan will call you back on Monday to schedule a virtual meeting or an in-office meeting with one of our team of advisors. Start planning for your retirement now. Call 833-946-7384 or visit AkersFinancialGroup.com. Check us out on Facebook, on our Facebook page. And then there's this. What are you going to do when it comes for you or your family? Extended care needs. What are you going to do? We will talk more about this in the second quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back. I'm Brian Akers. Today we're talking about long-term care, and the important word is care. The real threats to your legacy and retirement. Here in the second quarter, we have this important question about long-term care, and that is this: what are you going to do when it comes for you or even for your family? We've invited a special guest today. That's Jeff Stemler from AMS, Vice President of Advanced Planning. He has many designations and many years of experience, and him and I have worked together for at least 15 years on different topics and subjects and clients. And so, Jeff, what are your thoughts on caregiving and caregivers?
Well, the first thing that is clear to me is that most people that are contemplating long-term care coverage and things of that nature, they're thinking about themselves, and there's almost like no thought toward caregivers. And one of the things that I really try to stress when I'm talking to clients is that long-term care plan, long-term care insurance is not about you. It's really about the caregiver. And the fact is, as we mentioned in the last segment, this is a catastrophic event for the caregiver themselves, because first they're emotionally tied up with the person who needs the care, but also, again, their life is going to change, and their life as they knew it is no longer going to be theirs. And so part of this whole planning is I try to get across to people that you need to do this planning because of your love for your caregivers, and allow them to have a life. Allow them to manage your care, not be the sole provider. What also people are not aware of is the caregivers can become just as sick and needing their own care because they are taking care of other people. My aunt was diagnosed with leukemia. We asked, how long does she have to live? And the doctor said, oh, it's a slow progression. She's probably got several years. And everybody sighed some relief. But about 3 weeks later, her husband became totally incapacitated. Matter of fact, they live in Maryland, and they had a 2-story house. And so there she was, going up and down the stairs, changing him, the laundry, everything. And about 3 months after that, he passed away. He died on the 1st of the month, and she died on the 30th. Literally taking care of him killed her. And it's pretty dramatic, but it was an actual event, and that's why we really do have to figure out how do we put together an intelligent plan.
Yeah, my family, my grandparents, 3 out of 4 needed care. And some of the hardest things to see your parents and family do is trying to provide that care. Because I guess if you say it simply, people don't want to go to a nursing home or assisted living facilities. They say, I don't want to go, but then they don't understand how expensive it is to stay home if you don't have family to take care of you. And family, to ask them to do 24 hours is really too big of an ask when it comes to what is a proper plan. We got to be able to have a version of a plan that'll fund 8 to 12 hours minimum and still have some family help. It's a combination where that family can actually manage in and through the issues of medical conditions and problems. So there's a lot going on there. What's your general advice when you're talking to family and about funding and how to do this? How can you help a caregiver, like if you're somebody getting ready to retire and you can see that I might need to be a caregiver and then later on I'll have to be the one taken care of. What's your general advice as someone's getting ready to retirement about all of those kind of concerns?
Well, obviously the first thing is to have the discussion. And, just by the way, as you were going through the last segment there is one thing I wanted to bring up, is that it's very hard for the family to reject or not volunteer because they care about these people greatly and their heart's broken, and the thought of putting them in a home is, the last thing on their mind. And the thing is, normally it's the spouse who tries to take over, but if they're incapacitated or if they're no longer around, it ends up being the children. And the kids do get involved, but my experience has told me there's an actual formula kind of how this works for the child becoming a caregiver, and that is the one closest geographically is normally anointed as the caregiver. And if there's a chance between a son or a daughter, the daughter's going to get picked. And the other kids, though, will stay involved in the caregiving, and that basically they'll take one of two tacks. They're going to say, "Sis, why aren't you doing more for mom?" Or the other one's going to say, "Sis, why are we spending all this money on mom?" The caregiver is right in the middle and gets it in the neck. So that's and I've seen that. I mean, it tears families apart over this whole issue. So my advice, again, when I'm sitting down with, say, it's the parents, I share those stories with them, and I say, guys, you really got to consider how do we give their life back to them? And the way you do that is there's enough money so that they can provide or manage the care and not be the caregiver.
Yeah, that's what you just described is a situation that is real. And that situation is real in many families when it comes to how do we take care of someone. And then the hard part is once you start, how do you wave like a white flag saying I'm wearing out. There's lots of issues when it comes to this. What we're trying to talk about today is long-term care, and the important word is care. We want your family to have a family plan for you, a family plan for parents and other family members. Wherever you might be required to provide care, you need to have a plan on how that's going to happen. In other words, that person's wishes. Do they want to stay home? Do they want to go to someplace to be taken care of? Most people want to stay home. But the reality is that finances dictate where people get their care. Finances dictate who does their care. So when it comes to what we've been living through over the last year with, I call it a new COVID world, people look at what happened in facilities and they're a little fearful of going into a nursing home or a facility. And so they're like, well, I want to not go. I need to be able to stay on my own. And my answer to them is there is only one way not to go, and that is to be able to pay for it completely yourself. What have you been finding, Jeff?
Oh, no, that's exactly it. And, again, I think that most people that I'm talking to now, they had some discussion about this in the past. And again, they were confronted with the fact that it was an ongoing premium payment, that the premium payments were going up, and the biggest education point on my part is to help them understand those policies basically are dinosaurs, and they don't really exist anymore. There used to be dozens and dozens of carriers that offered long-term care, but they all mispriced it. And so, like I say, we now have a new generation of products out there where they're called asset-based, and these products, you know up front exactly what it's going to cost. And by the way, one of the points I try to make to them is that everybody has some just-in-case money, emergency money. And I said, and why do you maybe actually segregate it or mentally segregate it, but you're not going to touch it, right? Well, that's in case you need it, right? Well, the problem is that they're just hoarding some cash and they're not utilizing it through some leverage that insurance provides. So we do help them find the money.
Absolutely. And so what happens is this, when you're out there driving your car today and you're hearing the radio show and you're thinking about, oh, this is depressing. The reality is this, let's put this out front, especially as you get ready to retire. How are we going to address this? How are we going to plan for it? And let's try to understand some of the issues that are there. One of the big issues is this. When someone gets sick, it's typically something that starts sudden. Then there might be some recovery. So in other words, you might end up in a hospital. Then in the hospital, they basically are, you're improving. As long as you're improving, your regular health insurance covers that care. Then you go to a rehab, and that rehab, their job is to get you to a level of maintenance where you can actually be maintained. The hard part is that while you're improving, it's covered. While you're in rehab and doing therapies, things like that, that's covered. But when you get to a point where you can't progress anymore, you're then at the next level of care, and that's where extended care or long-term care kicks in. And that is when you need to start writing the checks yourself. Some people can self-insure. Some people need to pay. Some people don't have enough money, so they need to rely on the state. These are all issues of financial planning. So what happens is this. Many things have been happening in our life, and we need to think in a different way. Maybe you've been in a reaction mode about everything in your life, defensive in every way. It's like you're sitting on a sofa. You keep moving back and back, reacting to what goes on. Reacting has an energy of being defensive, negative. Creating, now you sit up and sit forward. You have the forward moving energy of creating. The people who will get through this and all that life's challenges will be in the best shape for this, will basically take advantage of opportunities that are there and be in a creating mode, in a solution mode. It's a choice. We want you to win in retirement by taking this opportunity to begin planning with us at Akers Financial Group. To schedule your free meeting, give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message, and Susan will call you back on Monday to schedule a virtual meeting or an in-person meeting with one of our team of advisors. Start planning for your retirement now. Give us a call at 833-946-7384 or visit us at AkersFinancialGroup.com. Give your family their life back by allowing them to manage your care, not provide it. We'll provide more information on how exactly to do this in the second half of our show, Winning in Retirement.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, a certified financial planning practitioner from Akers Financial Group. Today's topic is long-term care, and the important word is care. We're talking about the real threats to legacy and retirement for you and for the caregiver. You could be the caregiver or the person that is ill. Today, we brought a special guest, Jeff Stemler from AMS. He's a vice president of advanced planning, and we're bringing him out of the locker room. So, Jeff, you went to Ohio Wesleyan, played football. What is your way of getting ready at halftime, and how do you come out at the second half?
Well, the one thing that I remember most is if you had really good coaches, they kept you focused. They didn't want you to be too high, too low, and they wanted you to concentrate and visualize exactly what you're going to do in the second half.
All right, so you weren't one of those oranges kids. You didn't just eat some Gatorade and some oranges.
No.
All right. So we're focused. We're going back in here in the second half, and we ended the last quarter talking about give your family their life back by allowing them to manage your care, not provide it. That leads us right to what is the answer when it comes to what's out there. What is the answer to be able to give your family their life back?
Well, this is probably when we're at this point sitting with the client, it's all about education, because most of them say, oh, well, obviously you're talking to us about long-term care insurance. Well, there's more to it than that. The first thing is there's actually documents that you need to have, and these are essential for everyone. And the first one is called a financial agent. And this is a person that is appointed so that if you are incapacitated, they're the one that can take assets that are not inside of trust and use them for your benefit. So, for example, you have a checking account. The financial agent is the one who's allowed to write checks, to pay the bills, get the groceries, things of that nature. Now, if you have a trust, the trustee will handle all of the assets that are in the trust. The financial agent handles all the assets that are not in the trust. And that is very, very important, because when my mother went down to take care of my aunt in Maryland there, when she first got there, and my aunt was still alive, she went to the bank, and it never dawned on her that, she couldn't get money out to take care of my aunt. And they, of course, said, no, you're not on the account. There's nothing we can do for you. So luckily, she was able to get my aunt down there and sign the paperwork. And then they did go to an attorney and get the rest of the documents. And the second one that you need to get is appoint a health agent. And that's the person who actually can talk to the doctors, make decisions about your health care and things of this nature. And that normally is a spouse, or it could even be the same person as your trustee. The one caveat, though, is they do have a lot of power, and you want to make sure that you pick the right person, because they do have the power to, if you're comatose, to pull the plug. And if that concerns you, then the final document is the living will. And that one is very, very important, because that's the will that actually, it's the instructions to that health agent of what he can or can't do. And they make, and you will have in the living will already pre-made your decisions about prolonging your life, what actions they want, things of that nature. So those are the documents that are essential for everyone. And then, of course, we get to the long-term care insurance. Did you want to go through that at this point?
Absolutely. I was just going to mention that our website, AkersFinancialGroup.com, we have our webinar series. If you click the webinar tab, you'll find that last fall we did a talk on estate planning and these documents. So we had special guest attorneys speak at our webinar. Go to AkersFinancial.com, check out our webinar tab, and find out more about those documents that you need. This would be if you're caught into a situation where you are becoming the caregiver for an aunt or for parents. You need to get these documents as quickly as possible if they're not in place. I believe that each and every person, as you're getting ready for retirement, needs to have an estate planning review and get all the documents in place while everything's great, everything's going well. Cover all the worst-case scenarios. Now, Jeff, this next topic is about how we manage to provide for this care through the use of different types of insurance policies. How do we do this, Jeff?
All right. Well, like I said, these are different than the old days, because remember, traditional long-term care policies were written just like auto insurance. You paid the premium, you didn't have a claim, the money was gone. And also, you were pooled in a risk pool, and if the claims went up, your premiums went up. Well, now what they've done is they have changed these products so that they're a hybrid between life insurance and long-term care. And the reason why this is so important, life insurance, the actuaries know exactly how many people will die at a given age. They just don't know who. And so by having a life insurance chassis, the premiums can be calculated with great accuracy. And you have many options. There's single premium. There is multi-year premium. There are many ways to come up with the money to fund this. As I mentioned earlier, you had your just-in-case money. If you've got money setting aside right now to cover an emergency, you can put it into one of these policies, and if you need that money, you can have what's known as a return of premium rider. So, again, you can put the money into the contract and get the leverage, but if you need it, you can get it back if that's really important to you. And so the other sources of funds for this, you may have an old life insurance policy, and you would like to take the cash value in there and put it into one of these products. You can do that, and you can do that tax-free by doing a rollover. Another thing is, a lot of people have 401ks. They're taking required minimum distribution payments. They don't need the money. Well, these policies can actually be put inside an IRA, and and the premium for the actual long-term care is taken out of the RMDs, the required minimum distribution. So again, that's a very unique proposition. And then, of course, if you have an old annuity, you can also put it in there.
All right, let me see if I can explain everything you tried to say there. Now, you said a lot of people have a rainy day fund, and that rainy day fund is sort of money for when everything goes wrong. And so what has happened instead of having what I call health care, long-term care, there's a long-term care policy that is actually under a life insurance policy. So that means someone has to be insurable. So this has to be accomplished while you're healthy. It doesn't mean you have to be young, but you have to be reasonably healthy to get a policy like this. And you're saying there's many ways of funding it, from annuities, life, cash, and IRA money, all kinds of ways of funding it. But the idea is to take what you might have earmarked, might be a bucket of money for long-term care, and you can turn it into a policy that'll give you more benefits. Is that a simplistic way of explaining what you just said, Joe?
No, you're right on. And just one other thing, though, I do want to mention: if you are not in good health, there still are some other options. And one of those is a lot of the annuities that are available now have what they call a nursing home rider. And so while you buy an annuity, which does not require medical underwriting, at the back end, if you are needing funds for nursing home, you can turn it on, and in many cases, whatever is the normal payout will be doubled, so that you have extra cash to take care of any long-term care expenses that may occur. So even if you aren't insurable, you need to go and see Brian and his staff, because they have annuities that do have this nursing home rider.
Exactly right. Well, Akers Financial Group, we are life and health insurance agents. We provide these kind of policies for clients when it comes to their situation. We serve as like a broker in that we shop different companies. We're not working just with one company. So understanding that there's lots of choices, we think financial planning leads to the ultimate answer of what is the right decision. Akers Financial Group is a local, independent firm. We don't work for a big insurance company. We don't work for a big firm on Wall Street. We work for you, the client. And then what we do is we do work through insurance companies. And then when the agent works with the insurance company, they are representing what the insurance company provides. But we try to do, as a fiduciary, the idea is to what does the client need, and then what is best for you. We have offices in Forest Hill and Lutherville, and we see clients all around Maryland, the Mid-Atlantic region, and around the country. We want you to begin winning in retirement with us at Akers Financial Group. Give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave a voice message, and Susan will call you back on Monday to schedule a virtual meeting or an in-office meeting where you can meet with one of our team of advisors. Start planning now for your retirement. Call 833-946-7384 or visit AkersFinancialGroup.com. Are you ready for a worst-case scenario? We'll talk about that in the fourth quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm your host, Brian Akers, certified financial planner, practitioner, and president of Akers Financial Group. Welcome to Winning in Retirement. Hey, it's the fourth quarter already. This show has flown by. If you came in late, missed parts of this, want to hear this again, you should go to AkersFinancialGroup.com. Hey, we spell Akers, A-K-E-R-S. A-K-E-R-S, financialgroup.com. You go there, you can see our radio tab. Hit the radio tab, you'll see all the shows we've had in the past, and this show will be available online within a few days into next week. and it will stay there for a while for you to listen to it as a podcast. Today we have expert Jeff Stemler from AMS, a vice president of advanced planning, who's been helping me for many years in designing what my clients need when it comes to their long-term care concerns, needs, and actually implementing what is the right plan for them. So today's show has been a long-term care with an emphasis on the important word care, the real threats to your legacy and your retirement. Now, this segment, Jeff, is about, are you ready for a worst-case scenario? That worst-case scenario is where we want people, as they get ready to retire, to think about a worst-case scenario and do something about it. That doing something about it is to look at and consider long-term care life insurance, asset-based life insurance. Can you explain further this kind of concept for people?
Sure. In the last segment, we talked about the money is normally available. People just are not aware of it. They're afraid of spending, I can't afford it, ongoing premiums and things like that. But if you do have a nest egg, your emergency fund, your just-in-case money, this can be used to pay for the long-term care. Again, if you've got a 401k and you're taking required minimum distributions, you can use that. And the key here is, since this is life insurance based, the premiums are guaranteed. So you can make a single payment, you can pay it 10 to 20 years, or you can pay it for a lifetime. And when you get the policies, or the policies are very, very robust and have many options. And that's a reason you need to go in and sit down and talk with an expert. But some of the options on these policies are these. If you are saying, yes, I need that just-in-case money, but I'm afraid to tie it up, you can actually get a rider on these policies that's called a return of premium rider. And this rider is designed to allow you to get the money if you need it at any time. The second thing is, when you're looking for these long-term care policies, you want to be asking questions or have that expert really help you understand the policies themselves. And so, for example, some of them have waiting periods before they start paying for the care. Others, there are no waiting requirements. They start immediately if you lose 2 out of the 6 adult daily living activities, such as you can't get out of bed, you without assistance, you need someone for bathing and things of that nature, feeding. Trigger 2 out of the 6 of those, and they start paying. And another important thing is, some of these policies will pay for what's called informal care. So that is, if your son or daughter or even your spouse is the caregiver, the policies actually pay toward supporting them. Others, you need to have a licensed practitioner, a nurse of some nature, to get paid. And then I think the last really important thing is, some of them, you pick the amount per month that you want to receive, and if you trigger the 2 out of the 6, you're going to get paid that amount every month, whether you needed the money or not. Others are reimbursement based, and by that, they'll have a limit on how much they can pay a month. But if you had a $3,000 a month benefit and you only had $1,000 of bills, they'll reimburse you for the $1,000. The good news about that is that extra $2,000 that was available didn't go anywhere, so that continues to stay inside the policy.
Yeah, when I keep thinking about policy and design, I think about clients of mine that are in nursing care now and what it costs each month. I know the national average is around $90,000 a year, but I've found a variance of coverage between $6,000 a month all the way up to $12,000 a month, and even higher depending on private care and private companies. And so funding this is extremely important. I found it most important when there's a healthy spouse and a sick spouse, because we need money to take care of the healthy spouse and provide for the sick spouse, where if the healthy spouse can no longer care for the one that's sick, that they need to use a facility, that there'll be enough money to pay for that. So it comes these really tough situations in my clients' later years that we have to deal with. Have you seen that, Jeff?
Oh, absolutely. And the just as you were talking about that, one of my colleagues at the office, her mom went into a nursing home, and it was approximately $130,000. Just by the way, we have clients in Alaska, and it is closer to $200,000 if you want a private room. So it gets to be very, very significant. Let me give you an example, though. I've mentioned leverage. So let's assume you have $100,000 and there's a husband and wife, and they both need long-term care. Well, if you self-insure, if you put that $100,000 aside, you're only going to have $100,000 for long-term care. But we took that same $100,000, went to a company that has a unique feature. Both husband and wife can be on the same policy, and they receive the same amount of benefits. And the one thing that they were concerned with was outliving their money. So most carriers provide a continuation of benefits rider. This one particular company is very unique. They're the only ones that provide a guaranteed lifetime rider, and it can actually be set up so that it grows with inflation. That $100,000 we put into this product generated, if both of them became ill, there'd be $78,000 a year that would be generated by this contract. And I just did a quick calculation. If they triggered it at age 65 through age 90, that $100,000 would have paid out $1.9 million of benefits over that time frame. So that is why, if you do qualify for insurance, Brian's correct. The cost is significant, and this is a good way to leverage those just-in-case assets.
Yeah, so when I talk with clients, a lot of them say, well, I'm going to self-insure. I'm going to just handle it myself. What's your answer to someone that says that?
Well, again, if somebody does realize that they need to provide for long-term care some way or fashion, and if they're saying to me, I want to, I'll just self-insure, and I'd say, look, here's the deal. If you want to do this, why wouldn't you put the money into a policy with a return of premium rider? If you ever change your mind, you can just take the money back. If you get sick, instead of having $100,000, just as I gave in that example, that's going to pay out $78,000 a year. My goodness, by a year and a half, you're already would have consumed 100% of that $100,000. So I say to people, it's good that you're prepared to self-insure, but why would you do that? Why would you tie up the money? By the way, one of the things that we do know is I've asked the question to somebody, how much have you set aside? and they'll say, 200,000, 300,000 out of $1 million. I'd say, well, here's the deal. If you don't have a plan, then it's not 100,000 or 200,000 that's being set aside. It's your entire net worth that's being set aside. And so we really try to get across leverage is a very, very good thing.
Yeah, there's a lot to this, Jeff, and thank you very much for being on our show today to go over long-term care and why it's important to understand the word care. When we care for our family, when we are the caregiver, or if we're the person that's ill. One of the big things that Jeff brought up today was this: give them their life back by allowing them to manage your care, not provide it. And that's what this show is all about today, managing the real threats that are they're threatening your legacy and your retirement. Make sure you have a plan so you can have a lower stress retirement. So things like this are already handled or at least thought about, where, like Jeff mentioned, 93% have not done anything about fixing this in their own scenario. So give Akers Financial Group a call to sit down and go over these ideas. Give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message, and Susan will call you back on Monday to schedule a virtual meeting or an in-person meeting. Of course, that's mask to mask nowadays. We're doing some of those in the offices. Start planning for your retirement now. Give us a call at 833-946-7384 or visit us at AkersFinancialGroup.com. Thank you for listening. I'm Brian Akers from Akers Financial, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment.